Well, good morning. My name's Chris Gosling from Australian Fund Monitors. And this morning we're talking to Kristiaan Rehder from the Bennelong Kardinia Absolute Return Fund. Kardinia was established in 2006, so it's been around for 14 or 15 years, which is an extensive track record. And if you look at the following charts, you'll see with Kardinia in blue versus the ASX200 in red, that while it's never shot the lights out as such, it has always protected capital, particularly in times of extreme market volatility. This first chart, Cumulative Performance, shows that in the GFC, the fund went sideways. And whilst again, it hasn't made as much money in the last 2 or 3 years, it has avoided the sharp sell-off, particularly the COVID-related fund that we've just gone through or are going through. If you go to the next slide, and again with Kardinia in blue versus the ASX in red, you'll see the drawdown. And the drawdown shows that the fund doesn't lose much money in negative markets, so it protects capital. And again, you really dramatically see that both in 2009 and again in 2020. Finally, the third chart just shows this again. We're looking at the performance of Kardinia versus the ASX200 in the worst and the best months on the market. So you can see on the left-hand side, the worst months on the market, potentially down over 20% when the fund only loses 4 or 5%, consistently does better in negative markets. Now against that, of course, you can't have it both ways. It doesn't go up as much in the really strong bull markets. But protection of capital is one of the key factors of the fund. Let's talk to Kristiaan. Kristiaan, we're back in the office grinding away. You're still in lockdown down in Victoria because things are a bit tougher down there. You've had a breakout. But tell us a bit about what's been happening to the fund and your views on the market, given that we've been through this incredibly tumultuous time, and whether you think we're coming out the other side of it yet.
Look, it's been tremendously difficult in managing money through this climate. I don't think there's anyone alive today who has lived through a pandemic of this scale. So a lot of people kind of talk about what's coming next. I'm not sure anybody actually knows what's coming next, and it's created a huge amount of uncertainty for everybody. So very few people were positioned for the sell-off that we saw in February and March, and to add insult to injury, many didn't predict the rebound and the strength of rebound we've seen since the end of March. So it's been a very, very difficult time. And I guess the way that we have been managing through this is we've really set our portfolio up, and this is just part of our investment process to try and perform well in all market conditions. And the way that we do that, first and foremost, is we have a cap on the level of our net exposure that we can hold at any one time. So our net exposure is capped at 75%. So by definition, it means that 25% at a minimum will be invested in either shorting equities or cash, and that provides a natural buffer to the strategy. But look, it's very difficult. There's no two ways about it. Having said that, there are some observations, I guess, that we can make. And first and foremost, the amount of stimulus that's been thrown at the economy is gigantic, and it's actually quite breathtaking. In terms of fiscal stimulus, it's around 3 times larger than what was thrown at the GFC, and arguably over a shorter period of time. We've seen all that stimulus come over the last 2 to 3 months, and that has proved to be very effective at stimulating markets and supporting equity markets, supporting the economy as the economy was shut down. So all eyes, I guess, are currently on markets and the economy and how we now muddle our way through the second wave, I guess, or a further spike in the infection rates. We've always said, we've said this to you, we've said this in our written pieces, that we don't actually think the virus now is the main event. We think it's really the economy, and we're very much focused on the economy and corporate earnings. Now, how the governments react to this recent spike, I think is going to be key. If they can target selective geographical regions, or if they can target specific industries and allow the broader economy to open up, then we might just be able to muddle through this. But if we go back to hard lockdowns like what we saw back in March and April, then I think equity markets really have the ability to fall quite steeply from where we are. So we're watching very closely at the reaction of authorities, not just here, but also globally in the US, as to how they confront this recent spike, I guess, in infection rates.
Would you say that the economy, which is being supported, is perhaps not really in tune with the markets, which seem to have rallied, quite significantly, albeit that they fell overnight and they will rise and fall?
It does feel like equity markets have gotten ahead of the fundamentals. Bearing in mind, markets always look ahead. They look 6 to 12 months ahead of time. There is a lot of stimulus there. I think this rally that we've seen has been disbelieved from the get-go. And if I look at all the statistics around the market, I see there's a lot of cash still sitting on the sidelines. There's very few funds that are fully invested. Now, the consensus trade, therefore, to my mind, is still bearish, and the market's going to fall, and it may even retest its lows. Now, from my experience, whenever you've got the investment community positioned in the one direction, typically the markets do the exact opposite. So that's a long-winded way of saying it's very difficult to know. Consensus trade looks like it's for further falls, which means the pain trade is probably up. Markets might therefore rally for longer and higher than what most people expect. I think all eyes in the very short term will be on this infection spike rates and how governments respond to it. There's obviously a fiscal cliff that Australia is facing in September. We have been major beneficiaries of the JobKeeper and the JobSeeker initiatives. Both of those roll off on the 30th of September. What's going to happen post that remains to be seen. That's something we're thinking a lot about at the moment. From our perspective, we have a net that is low. At the end of today, we'll have a net that's below 10%. So we are treading in the very short term very cautiously. But I think over the medium term, I'd say that we are reasonably cautiously optimistic, is probably the best way to describe it.
On the detail of the portfolio, Kristiaan, are you having to rotate out of sectors? I mean, there's been a recent rotation just in the last couple of weeks into value stocks. I mean, this constant rotation, or are you just saying, well, we'll avoid certain sectors or buy when things look particularly cheap?
Well, that's an interesting question. A lot has been written about and spoken about in terms of value versus growth. The way our portfolio is positioned at the moment, it is very diversified. It has good exposure to healthcare, to bond proxies. We have some exposure to retail. We have some exposure to energy. We have exposure to tech. So very broad exposure across the board. What I would say is that we're generally agnostic about this whole value versus growth trade. I mean, at the end of the day, we are fundamental stock pickers. We spend a lot of time analysing company from the bottom up. I like to explain it a little bit like people-to-people interaction, that people are attracted to certain characteristics of other people. And it's no different to fund managers. We are attracted to certain characteristics of companies. And the characteristics that appeal to us the most are companies that have got sustainable and predictable earnings growth. They have industry tailwinds. They have strong balance sheets, strong management teams, and they're offered and they're trading or being offered up at an attractive price. Now, in most recent times, there are a number of companies that fit that description perfectly, except their prices historically have been too high, which has prevented us from buying them. But over the last 3 months, we've actually seen those characteristics persevere or persist, but yet the prices have come back into a range in which we have become comfortable for the first time in putting money to work. So some of the names that we've added to the portfolio in the sell-off has been JB Hi-Fi. Another example is IDP Education. Both those names are companies that we've liked for a very long time. And for the first time in a while, their share prices and their Ps have come back to us to attractive levels, enough for us to invest. So, look, we're very much bottom-up stock pickers, and we don't spend too much time thinking about the whole value versus growth argument.
Kristiaan, we're going to see more volatility, I believe, and more challenges. I think Australia, although you and Victoria are suffering a little bit at the moment on this spike, in global terms, it's hardly a blip, really, when it comes down to it, and hopefully it doesn't get any worse than it does. But globally, it's fair to say, I think, that this has a long way to run, probably until there's a vaccine. And even then, the damage to the economy is considerable. And the ongoing damage, we saw Andrew Liveris come out this week in the Financial Review saying there's a long-term damage to the economy. I think Peter Costello's been vocal on this as well. Risk aversion, I think, is going to be the way to go, and I think that's going to suit what you do and your style pretty well.
Yeah, that's right. I mean, I think absolute return funds, the ability to set your portfolio up to be able to make money in different market conditions, really is a strategy for the time. Now, you may say I'm talking my own book, and it's within my interest to say that, but I genuinely believe that. I think we are facing very unusual times, very uncertain times, and the volatility is here to stay for some time. So you really need the ability to protect the capital foremost above all else, and then hopefully you can pick up some performance along the way.
Kristiaan, it's been great to talk to you. Thank you very much for your time. Really useful, really interesting, and keep doing what you've been doing.
Thanks, Chris. Nice to speak to you.